Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, we'll continue with financial accounting. We've already taken some baby steps to first learning what are the financial concepts that we need to learn, and knowing how the balance sheet, the income statement, the cash flow statement work. And also, last time we saw how all of the statements are interconnected. And when you have any transaction, you would always affect two financial elements. What we're going to focus on today is going to be the hard things that start appearing on finance, because these were just the basics, but now we're going to start going deeper and deeper into how each transaction can affect. So for today, we'll study revenue recognition and also accounts receivable and what this value means when we're updating it. Let's start with revenue recognition. And this recognition has 5 steps that we should always consider. The first step is the easy one, and this one is identifying the contract that you have with the customer. As soon as you have a contract, either implicit or implicit, this is going to mean that the transaction was agreed and there's an acceptance from both ends. After that, we're going to move on to the second step, which is going to usually be the hardest one, and it's knowing specifically which are the performance obligations that are in this contract. Performance obligations are going to be exactly what the company needs to deliver to the client. And even though this may sound simple, for example, if I'm buying a computer, I'm going to receive a computer, it's not as easy as it sounds. Because let's keep that example. Let's say I'm buying a computer. I'm not just getting the actual machine. I'm also getting the software. I'm getting the apps that are included. I'm also getting access to lots of features, for example, Bing's Assistant or Siri. Additional to that, I'm also getting the possibility of software updates or even the App Store, and maybe even a warranty. So all of this, companies should have in mind. What are all of them promising to the client, and what is being offered in each transaction? Because it's not something simple, it's going to hold lots of other things inside that transaction. And those are going to be called the performance obligations. And we have to identify which are all of the performance obligations specified in the contract. Then the third step is going to be knowing the transaction price. And this step is easier if you have some simple transaction. It might start getting a little bit difficult when we have, for example, price that's tied to performance or price that's tied to completion dates, but we're going to look at this a little bit later in the episode. For now, we should only identify the price. And then fourth step would be matching the price that you have with all of the performance obligations that were identified in step 2. So basically, it will be joining steps 2 and 3 together, and you will allocate the price to each of the specific performance obligations. Fifth, when we have already all of that allocated, we're going to look to recognize the revenue, but only when the entity satisfies each and every one of its performance obligations. And this is going to be crucial because timing matters here. If you haven't completed what you're supposed to do, you can't recognize it as a revenue, because revenue doesn't mean cash. Even if you already received the money, you can't recognize it if you haven't completed what needs to be done. So those are the 5 basic steps for revenue recognition. But I told you I was going to give you an extra advice, and those are going to be 2 methods for assigning revenues when the full performance obligations take a lot of time. So when these ones take time, it can't be as easy as what we mentioned, because sometimes either price is variable or the performance obligations can be met easily. So we have to figure out ways to start recognizing revenue throughout the project. This is an example that's usually going to be seen in construction projects. And so there are two methods for doing this. The first method is the percentage of completion method, also known as the PCM. And in the percentage of completion, you're going to recognize the revenues based on the percentage that you have completed, which seems relatively straightforward. If you already completed 20% of the project, then you're going to recognize 20% of its revenues. But what if it's too uncertain? Then you would have to use the cost recovery method, which is also known as CRM. And this CRM is different from Salesforce. This one's going to be talking about the cost recovery method. And this one would be applied when revenues are limited to the costs incurred, and then we're going to only put them until all costs are covered. So, in brief words, stated briefly, all profits are going to be recognized after all costs are recovered. And what we have to think is how many costs percentually have we used. If we already incurred in 50% of our costs, then we should already put 50% of our revenue. And we're going to start allocating revenue based on the percentage of costs, not on the percentage of completion, which was the previous method. So if you're working with a construction industry, you'll have to think of these two methods. If you are in a certain transaction that's not as ambiguous as this one, you could use the other method, which consists of the 5 steps. So identifying the contract, identifying performance obligation, identifying the price, then matching up the price with the contract obligations, and finally recognizing the revenue once the performance obligations are met. After this, I'm going to start talking about the accounts receivable, and we'll do a focus on the receivable because this is an important amount in companies. Accounts receivable, if you don't remember, is the amount of money that is owed to the company, either from its suppliers or from its clients. But what happens is that usually companies can't get or can't collect all of the money that's being owed to them. Specifically, let's think of banks. Banks can't get all of the debt that they're collecting, and there's only going to be collected a part of it, but then some money will be lost from the accounts receivable. And so how can we measure that? How can we show on our statements the value that is expected to be collected and not the value that it's total owed to the company? And for this, we'll have to look at a process in the accounts receivable part. I'll start first with the concepts because this one's going to be a little bit harder than the revenues. And the first thing we need to understand is that the total amount owed to the company, it's going to be the accounts receivable gross. So if you see the gross, it's going to mean that's the total amount owed. But this one's the one we usually don't want to see, because the total amount owed doesn't mean all of the amount of money they'll get. So if from all of this one, we're going to take away the allowance for doubtful accounts, which is the value that you won't be able to collect, and it's referred to from its initial AFDA, allowance for doubtful accounts, we're going to take the net accounts receivable. So I'll go back. If we take the gross account receivable and take the AFDA from that, we're going to subtract the money we won't be able to collect. Then we would get the net accounts receivable. And so the net accounts receivable is going to be only what it's expected to be collected. And for getting to those values, basically, we need a methodology because we have to determine the accounts receivable gross at the end of the period, as well as the AFDA. And from those two, we're going to determine our net accounts receivable, right? It's a simple equation. You just have 3 parts, and so we'll need 2 of them for finding the last one. So how do we find those first 2 parts, the accounts receivable gross and the AFDA at the end of the period. I'm going to start saying the simple equation, and then we'll look a little bit deeper into each one of those. But if you want a short summary for finding the accounts receivable gross at the end of the profit, we would start first with accounts receivable gross at the beginning of the period. Then to that, we would add all the credit sales, which are the sales that weren't done with cash, but they're on credit. Then we'll take away cash collections. So already you collected all this money. We take that away. And then we'll also take away the write-offs, which I'm going to explain a bit later. So this would be how we get AR gross, accounts receivable gross. And now, when we look at how to get the AFDA at the end of the period, we would start with the AFDA at the beginning of the period. Then we simply take away the write-offs, and then we may need to add or subtract any adjustments for it to make sense. And this equation looks simpler, it has less elements, but we're going to see what does this adjustment mean. So now let's start focusing only on the accounts receivable gross. How are we going to get that amount? And for this, we'll start with the initial receivables amount from the last period, which is going to mean that people still owed you a little bit of money, and now we're going to start from that value in our accounts receivable. To that, we're going to add all the credit sales, which means the sales that were done through credit. And this is going to account for lots of sales, because even if you're paying through credit card, this will take a couple of days of transactions. The company's not receiving the cash immediately. So credit sales are going to be a form of accounts receivable. So after you have your initial amount and you added the credit sales, then we're going to take from that the amount of cash that you already collected from all of these people that were owing to you money. So let's say I had 100 on credit sales, but I already managed to recover $90. So I'm going to take that out of the equation. We're going to subtract it because we already have that money. It's no longer being owed to us. And then imagine that after you're chasing the people that owe to you and doing every collection attempt possible, you still have an outstanding balance because maybe the individual is unable to fulfill its obligation, or maybe someone went broke and a company won't be able to pay back to you. So what do? You need to write a write-off. And write-off are going to be an elimination of the uncollectible amount in the accounts receivable that was recorded on the general value. So these write-offs are going to mean basically we are not going to be able to recover this money. We have to write it off, as the name says. So you're also going to take away the write-offs. And here we would go back to my equation. We had the accounts receivable gross from last period, we added credit sales, we took away the cash collections, and now we're taking away the write-offs. And this one is going to give us our final accounts receivable gross. But we still don't know the net value because remember, net comes from having this gross value and then subtracting the AFDA part. And so how can we get the AFDA? We start from the initial one from last period, and then this one's going to start keeping simple. Credit sales don't impact this number. Cash collections also won't have an impact on these numbers. But the write-offs do, because write-offs won't be collected. So these are going to be part of our allowance for doubtful accounts. But be careful, because this value, just taking the initial AFDA and taking off the write-offs, won't be the correct one yet. It's just the mathematical value, and we have to adjust it. And for this, I'm going to be appealing more to your common sense, not the accounting part. And why is this? Because let's say, for example, that from the math, I had started my period with an AFDA of 1. But then from the write-offs, I subtracted 1.5. So my new AFDA would be negative 0.5. And if I take that amount and add it, and so let's look at the equation. I had my total amount, and I'm going to subtract the value that I'm not receiving. But if this value is negative, it means I'm adding it. So would the net money to be collected be more than the total amount that I'm owed? This makes no sense because you can't collect more money than the one you're being owed. So here the math part won't work simply because this is meant to be an adjustment from the adjusted accounts that weren't able to pay back to you. And because it's an adjustment, we have to treat it as an adjustment. And for this, we're going to need to go to the math part, and we have to start this process the other way around. Usually, what companies are going to do is that they're going to give an estimate of the amount that's going to be collected. So we're going to take the estimate, which was initially the value we wanted to find, but here it's going to be our final product. Estimate is going to equal the accounts receivable gross minus the AFDA, right? So now we want to know what is the value for AFDA. And if we clear up the equation, very simple, you just have two numbers, subtract them, and you get the AFDA. That is what you're going to need to have as a product for your new AFDA. So this is turning things around. When you are looking for the AFDA number, what you have to look is for the adjustment, not really for the final value, because you already know how much money was your gross accounts receivable. We already calculated that. And we have an estimate for how much money we'll be able to gather. So the value that's key here, it's going to be finding the adjustment for our AFDA. So finding the missing value that will fit in this equation. And as you can see, this is an ambiguous number because companies could say that they are expecting to only collect one amount, and that would affect the AFDA. This is what usually auditors are looking for in companies. They're looking for this value to be consistent because they can't say that they're not expecting to collect something when they are actually expecting to collect. And all of this process would be just for recognizing the accounts receivable value and getting to the net value. I hope this was useful, and I'll see you in my future episode.